Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here on Options Guide TV. Today's date is Friday, February 9th. Guess what? S&P 500 index hit 5,000. I didn't have time to run out and get my hat made. I intended to, but I didn't get up early enough this morning because the core PCI numbers came out and they were not adjusted. In other words, the fact that we are down 2% on the inflation data since 2022. And it was basically confirmed, and they didn't really adjust the numbers much, but the marketplace really liked that. And as soon as that happened in the S&P 500 index futures, we had a big spike up, actually a fairly substantial spike up, came back down before the open of the actual market in the S&P 500 index. And the index opened above 5,000, opened right at, well, I don't know exactly where it actually, I could look at it and see exactly. Oh, there it was. It was pretty close. I was going to say 5,005, but it opened at 5,004.17. And this is fairly significant for Options Guide TV because we have been doing skip strike butterflies around the 5,000 mark a lot, basically every week for approximately 5 weeks, like waiting for it to get there. So if it opened at 5,000 on the number, that would have been very close to a home run. You'd obviously need it to close at 5,000. And right now it's annoyingly at 5,014.90. So this is a very sensitive butterfly that we put on last week as a paper trade in our TradeHawk software account. And it was funny because we debated, and I do remember this because I do like to trade these personally. We debated if we were going to do it at 5,000 or if we were going to make the precipice, the center point of our butterfly 5,010. And the 5,010 would have worked out better, but 5,000 was, it just didn't think that it bumped up against 5,000 for a couple of days. Kind of surprised that it made it through going into the weekend, and it looks like it's going to stay too. I don't see any hints that we're going back below 5,000 at this point in time, except for the fact that it's 5,000. And for some reason, the indexes have a tendency to gravitate towards these big brown numbers. That would be my only rationale. There's nothing in the marketplace to say that we can't keep going from here. The numbers are looking good. The potential rate cut is still fluctuating somewhere in the next Fed meeting, which at this point in time is, let me see where I have, I'm just going to grab this real quick. Sorry, I didn't mean to jump there. I thought it was on a different screen. But the potential Fed rate right now, we got 40 days till the next meeting. March is around. I'm sorry. March, this didn't move hardly at all. In other words, we're still at an 80% chance of the Fed rate cut being of no rate cut in March, but May has moved quite a bit. So now in May, there's a higher probability of a rate cut than there is of it staying at the current rate. There's a 40% chance it's going to stay at the current rate. 51% chance of the rate cut at this point in time, but we're quite a bit out. Just keep that in mind. And a 9% chance, which I find just blows my mind, that the Fed futures think that a 50 basis point cut might happen in the Fed funds rate. So interesting to say the least. And so basically the numbers that they had before the market today were all about just confirming that we're having disinflation. So a lot of times they will revise numbers that are put out by the government. So I think obviously the market has reacted extremely positively to this because we have pushed up and set all-time highs in the S&P 500 index. So this seems to have a lot more weight than when the actual number is announced, and mainly because they're really saying this is the line in the sand. It actually happened. We're going to confirm that it happened, and we are down 2% on the inflation data over the last year. So what the Fed is doing is working. Okay. So since I'm here and didn't intend to come over to the options playbook and the FedWatch tool, I was just looking for the number. But with that said, let's go and talk about this trade. We talked a lot about this trade, and I think to me it was just the fact that 5,000 was a great target. You could sell short spreads. We build this not as an alternative to a butterfly, but we build it as an alternative to a short spread. So you have a short spread that basically has your hedge in it, and that's a skip strike butterfly. Now, I've gone, if you've watched the show or been a fan of the show, if you've gone back, I've reiterated this many times because it's a tough concept to grasp. But inside my book, the options playbook, we have skip strike butterflies with calls. And I do usually like to do them on the call side, and especially when there's this big round number on the end, something that it can bump up against and just keep bumping and hopefully stay below that strike. And we missed it, it looks like one day, honestly. But we've been doing it for 5 weeks, approximately 5 weeks. Maybe it was 4. But with that said, this is where the market was at yesterday, right here. The close of the market right now, this would be 5,000 in our skip strike butterfly. The close of the market was within a point of that. And this morning it opened right here. And now it's gone all the way down here. So on the open, you would have had to get out of it. And my rule of thumb with the skip strike butterflies is if we break through this price, because we're always doing them out of the money, and if we break through our short strike, you consider getting out almost instantly, because you just really don't want to go beyond the strike that you skip in the standard butterfly. So in our instance, it was 10 points wide from strike A to strike B, and then another 10 points from strike B to strike C, but we skipped it and went to strike D. So that made this spread your risk. This is your short spread, a 20-point wide short spread. All right. So if you didn't get out, it wasn't meant to be a paper trade, but if you didn't get out, you're now in trouble. So we went from smelling like a rose last night to the point now that if we get anywhere above this strike, the trade's going to be hurting. And every hour that goes by, because it's the last day to trade, if it doesn't come back within the range, it's going to hurt. So that's my general rule of thumb, even if I'm down, because it is possible that you would have put this on. We put this on Friday, and the market would have ran all the way up to 5,000. And then let's say it did it on Monday, and we put it on Friday, did it on Monday. You'd be down. Without a doubt, you'd be down on the trade if it got to strike B right on our center strike. And I would just still close it out. You would say, all right, it made more than a 1 standard deviation move. That's usually where we set them up at, right around that 1 standard deviation move and beyond. And so you just get out and you would take your loss. All right. So that was the trade. We've done it for 5 weeks now. I'm not quite sure what we're going to do on this Friday, because we've now broken through that 5,000 level. And we don't have our standard trade to put on for the skip strike butterfly. And we've been talking all week. Excuse me. Let me grab a cup, a little drink. We've been talking all week about earnings trades, and the earnings trades are speculative trades. You learn a lot about those trades, and more than not, they've been in the right direction because it's been a bullish market, and we've stayed bullish on the earnings. There's been a few that have been beaten up. One of them is PayPal. We looked at PayPal on Wednesday because they were announcing after the close, and we're going to take a look at that trade today. But the skip strike butterfly, or other people like to do iron condors and doing them fairly wide and doing them over and over again. That would have been tough in this market, but these are some staple trades that I don't mind playing. You're not messing with the volatility per se when you're talking about doing index option strategies where you're bringing in a net credit to the account. Part of the things about the indexes that are helpful is that they mute volatility. So a 2% move, especially on the open, today we had about I guess we're at a pretty close to a 1% move, I think, in the S&P 500 index. We'll go back and look exactly where we're at. But a 2% move on the open on the index just very rarely happens. And that's where your risk is when you're talking about trades like this, where you have this finger sticking out here that looks a little scary. That's where your risk is at, is that you can't trade out of them. They move too fast. And so I guess the moral to my story is I'd much rather continue to do skip strike butterflies in indexes or ETFs, something where you have muted volatility, don't usually have extremely huge openings like earnings that would cause it. And we've done a few of these on earnings, and they actually worked out pretty well. But with that mentioned, usually I'd rather do this if I'm going to do it on a routine basis in an index and in the S&P 500 index in general, because they settle in cash. There's some tax benefits. I'll let you look into that, especially if you're not in an IRA account or a retirement account. There's some tax benefits to doing index options. So there you have it. Okay, so let's jump back out. We've already jumped. Here we go. And let's go to the TradeHawk software. And let's look where it's at. I haven't looked at it since the open in the S&P 500 index. We want to make sure that we're on February 9th expiration. Welcome to the TradeHawk software, by the way. Here's the calls. Here's the puts. Here's the bid ask on our trade. We centered, it's easy. I don't even need to look at the strikes because we've been doing this for weeks on weeks. We're buying the 49.90, selling the 5,000, selling it twice, skip the 510, and buying the 50.20. So at this point in time, this trade should be hurting. That's a wrong click. There we go. 50.14. So we're in that bad range, down below, like we saw in the options playbook, down below the break-even point, and we're at expiration. So right now, we did this trade. We put it on for a net credit to the account of 120. So when we initially sold this trade, right, the credit was 120. Now it's showing the credit at 370. Okay, so if we're going to get out of the trade, this becomes a sell, this becomes a buy, and this becomes a sell. And notice now it's a net debit. So the difference from 380 minus 120 is $2.60. So if you wrote it and you did not get out on the open, you would have had a lot of emotion throughout this trade, and you would actually be at this point in time down $2.60 on your $1,000 margin requirement. And I would suggest that you would just close it out. If you wrote it all the way to the end, this is where I would be at. Would have closed it out on the open. It would have been very close to even on the open. You would have made that 120, which there were many opportunities to do that. And very frustrated that this one data point this morning pushed it hard above the 5,000 level. But such is life in option trading, because it could potentially have been a home run. Landing right on that 5,000 mark would, or even opening on the 5,000 mark would have been a real big deal this morning. And it was worth the risk to see where it was going to open at. In my mind, it was. I would have wrote it to the open and then just closed it out on the open. All right. Now, PayPal. So PayPal was kind of ugly. And I've been struggling with this one. I was trying to bottom fish in PayPal on Options Guide TV. And once again, want to emphasize it's not meant to be a recommendation. But if we look at, because this one does hurt, we look at the chart of PayPal. And just grab it right in this little corner here. We'll blow this up. So 2 days ago, this was Wednesday. We did Options Guy. Yep, that's the 7th. Did Options Guy Options Guy TV at 11 o'clock. At 11:30 on this day, it was trade. Well, we ended up on the low end. Trying to see where the numbers are popping up. We ended up on the low end, but I guess I can just look at it this way. 62.91, somewhere in that range. Market open now, it's down around 57. It is positive today, but we did 61 by 64 long call spread. And so we wanted the market to go up. We basically did it for $2, hoping to make $2. So we lost our $2. Like, it's not even going to be there. And that was the risk of doing the trade. We took the price of the underlying stock, but PayPal just can't get out of its way. I was looking for some capitulation on the downside. We had a fairly strong rally. We tried to buy into that rally, and that kind of hurt too. So I basically am tapping out. If anything, at this point in time, if we finish below, let's go way out. Let's do like 1,000 days here. 1 second. It's kind of been in this channel, and that's not right. We'll keep it right in this range. Okay. So it's kind of been in a channel right here, and actually the line is drawn. I guess I clicked on it. So right in here is a level of support. We broke down, came back. This is where the market was looking really strong. Like maybe we're at the very bottom of PayPal. This company's not going away. It's still a solid company, but competition is beating it up. And that is really what was the driver of the huge, like the stock got cut in half almost. Let's go out days. I don't know why this isn't working. All right. Yeah. So the stock went from 310. Yeah, definitely got cut in half right about here. And here was a huge gap down when that happened. And now we're down in this range. And if we break through this level where we're at right now, it looks scary, going all the way down to about 48.80. So things aren't looking good on the chart for PayPal, and poor earnings really hurt them. And I'm tapping out. That's simple. Okay. So other trades that we looked at, Lilly. And in Lilly, we did a skip strike, and mainly because it was so far out in time. So let's pull this back a little bit. And that's done really well. Actually, the market went down and now it's back up. And let me grab where our strikes were at. And I think that's where we're going to leave it today, because I really don't have a redo trade, nor do I want to. I kind of want to see the markets end up on that 5,000 mark, because now there's, in my mind, I want to wait to see where the market wants to go next. And I'd rather wait the weekend, see what happens, see where we close, honestly, and then kind of determine what type of trades that we might want to do are like continuation trade in the S&P 500 index. We still have NVIDIA going to announce earnings. That's one of the last mega cap tech stocks, but NVIDIA just isn't stopping. If anything, it might be a reason to sell the news going into their earnings, because they just keep going higher. It's trading at 716 right now. It's up another 2.8% today, and it's got to stop somewhere at some point in time. It can't just continue to go straight up. All right, so on Lilly, we did. I'm going to pull this graph up. We were right around the 800 level, right? So in this trade, we had to run up a little bit. And once again, we picked that nice round number, 790, 800, 820. And when we did it, we brought in a net credit of around 30 cents to the account. So this trade is going to work out. You would have had a $1,000 requirement, just like we did in the S&P 500 index. And at this point in time, where it looks like that's just going to expire worthless, we never made it to that range. So that trade worked out just fine. But once again, it's, to me, when I look at these, I'm considering doing a short spread, but I don't want to do a short spread definitely around earnings, because the gap potential on an underlying stock. So I'd much rather be in something like a skip strike, bringing in a little bit less of a credit, but already having your hedge in on that trade. So I think I'm going to leave it there today. A little short and sweet. I don't have a trade that I want to look at. We'll look at a few more earnings trades. We'll definitely be looking at the NVIDIA trade. If you have any questions, feel free, because we got a little bit of extra time today. But if not, we're going to come back on Monday. We're going to see where the market's closed at the end of the day today. And then we'll look at another trade in the SPX and look at a couple more earnings trades. And we need to go back to our paper trading portfolio of stocks, of deep into money calls, which one of them was Lilly and one of them is NVIDIA. And then we also have Home Depot in there that has done all right. Caterpillar had a good earnings report. That got called away. We actually closed that one out. And we'll have to start building our portfolio now that the earnings season is over. And I feel comfortable selling calls against those long, deep into money option positions. All right. Thanks for coming, everyone. Please click subscribe, ring the bell if you are on the YouTube platform for Tradier. Follow me on my X, under my X profile, which is at Brian Overby. And we'll see you this Monday for the next edition of Options Guide TV. Thanks for coming, everyone.